When you think about who owns all the Bitcoin, your mind probably jumps to tech billionaires tweeting from their yachts, or maybe that one cousin who won't shut up about it at Thanksgiving. You might even picture large corporations with names like Strategy that have famously stacked up digital coins like they're collecting pogs. And you wouldn't be wrong, but there's another group, a quieter, more industrious bunch, who are some of the biggest holders of them all, the Bitcoin miners. These aren't people with pickaxes and canary cages. They are massive, publicly traded companies running warehouses full of humming, heat-blasting computers. Their entire business is to solve complex math problems to validate transactions and in return, get freshly minted Bitcoin. Think of these miners as the digital equivalent of a central bank, except instead of a stately building with marble columns, their headquarters is a giant noisy shed in rural Texas. For years, the smart play for these companies was to hodl, or hold on for dear life, accumulating as much Bitcoin as they could. Their operating costs were covered, the price was generally going up, and holding on to their newly created coins was like putting money in a high-yield savings account that was also on a rocket ship. They were the silent giants, the whales swimming in the deep, holding vast treasuries of BTC that rarely moved, creating a bedrock of stability for the market. But the story, as it always does, is getting more complicated. Holding on to Bitcoin is a great strategy when times are good and the money is flowing. These miners have payrolls to meet, massive electricity bills to pay, and shareholders who expect to see some actual, dollars on the balance sheet. For a long time, they could do all that without touching their precious Bitcoin stash. They could use other sources of funding or sell just a tiny fraction of their holdings. This created a perception that miners were permanent holders, destined to accumulate coins until the end of time. But as we're seeing now, even giants can feel the squeeze, and their decisions are starting to send ripples across the entire crypto ocean. The key takeaway here is simple. The companies that create Bitcoin are also some of its biggest investors. They don't just make the stuff. They sit on mountains of it. Their behavior is a crucial indicator of the health of the entire ecosystem. When they're confidently holding, it signals strength, but when they start selling, it's a sign that the economic winds are shifting, and right now, those winds are blowing with the force of a hurricane, forcing these silent giants to make some very loud decisions, which brings us to the core of the problem, the ever-rising cost of doing business. So, why are these miners, who were once the ultimate Bitcoin believers, suddenly starting to sell? The answer is simple economics, which is a polite way of saying it's getting ridiculously expensive to keep the lights on. The business of Bitcoin mining has always been a race to have the fastest computers and the cheapest electricity. But recently, that race has turned into a brutal marathon where the finish line keeps moving further away. The first major hurdle is something called network difficulty. In simple terms, as more and more miners join the network and compete to solve those puzzles, the puzzles themselves get harder. It's like a global Sudoku competition where, every 2 weeks, the organizers add more squares and remove more numbers. This increasing difficulty means miners need more powerful, more expensive computers, known as ASICs, just to stay in the game. An older machine that was profitable last year might now be little more than a very expensive space heater. On top of that, the global energy crisis hasn't exactly done them any favors. Electricity is the single biggest operational cost for a miner, and as power prices have climbed, their profit margins have been squeezed tighter than a clown in a phone booth. It's a double whammy. The hardware costs more, and the electricity to run it costs more. This has pushed the average cost to mine a single Bitcoin to somewhere between $100,000 and $110,000 for many operators. Now, you might be thinking, hold on, Bitcoin's price hit over $126,000 this year. That still sounds profitable. And you're right. For a fleeting moment, it was. But the price has been volatile, recently dipping to around $80,000 before recovering to its current level of about $92,000. When the price of Bitcoin is below your cost of production, you are officially losing money on every single coin you create. It's like being a baker who spends $5 on ingredients for a loaf of bread that you can only sell for $4. You can't make up for that loss with volume, you just go broke faster. This is the harsh reality many miners are facing today. This economic pressure cooker forces a difficult choice. Take on debt or sell the one asset they have in abundance, which is Bitcoin. For a growing number of these companies, the decision has been made for them. They have to sell. This isn't because they've lost faith in Bitcoin's long-term future. It's a matter of sheer survival. They are selling not because they want to, but because they have to, turning their digital gold into cold, hard cash to pay the bills and keep their operations from grinding to a halt. To understand this trend, let's look at the big players on the field, the publicly traded mining companies that have to report their every move. It's like a reality TV show for nerds, and the drama is all in the financial statements. First up is MEA Holdings, a relative giant, holding around 53,250 BTC. They started selling small amounts, offloading 362 BTC in September, but then spooked the market by moving a larger chunk to an exchange in October. Interestingly, they then bought back about 400 BTC when the price dipped, suggesting they're trying to play the market, selling high and buying low, a risky game when you're also trying to run a mining business. Then, you have Riot Platforms and CleanSpark, two other major miners who have thrown their HODL strategy out the window. Riot has been consistently selling hundreds of Bitcoin every month this year, unloading nearly 3,000 BTC. CleanSpark has been even more aggressive, selling over 4,000 BTC since April. For these companies, selling has become a core part of their financial strategy. They mine Bitcoin, and then they immediately, or very quickly, sell a portion of it to fund their operations and expansions. They are treating Bitcoin less like a precious reserve asset and more like a finished product rolling off an assembly line, ready to be shipped and sold. In the other corner, you have the steadfast holders. Hut 8 Mining Corp, for example, has proudly not sold a single Bitcoin in 2025. Their ability to do this was helped by a clever partnership with Eric Trump to launch a venture called American Bitcoin, which likely provided an alternative source of funding. Then there's the new kid on the block, Kango Inc., which only started mining in late 2024. They hold over 7,000 BTC and have been very clear about their intention to hold for the long term. For now, they are the idealists, the true believers who are stacking sats and refusing to part with them. So what you have is a clear split in the industry. On one side are the sellers, like Riot and CleanSpark, who are using their mined BTC as a constant source of revenue to navigate the tough economic climate. On the other side are the holders like Hut 8 and Kango Inc., who are finding other ways to stay afloat so they can keep every coin they mine, and in the middle, you have companies like MEA Holdings, trying to have it both ways by selling and then buying back in. This division shows that there is no single right answer and each company is making a different bet on the future. If rising costs were a punch to the gut for miners, the Bitcoin halving was a roundhouse kick to the head. The halving is a pre-programmed event that happens roughly every 4 years, and it's a fundamental part of Bitcoin's design. It does exactly what it sounds like. It cuts the reward that miners receive for validating a block of transactions in half. Think of it like a piñata at a birthday party. In the beginning, every time you hit it, 12 candies fall out. But after the halving, you hit it with the same amount of effort and only 6 candies fall out. The most recent halving, in April 2025, cut the reward from 6.25 BTC per block to just 3.125 BTC. For miners, this event was catastrophic for their revenue. Overnight, their income was sliced in half. The work was still just as hard, the electricity bills were still just as high, but their paycheck was suddenly 50% smaller. Imagine your boss walking into your office and saying, "Great news, you're still employed. The bad news is we're cutting your salary in half, effective immediately. Keep up the good work." That's essentially what the Bitcoin Code told every single miner on the planet. This event is designed to control Bitcoin's supply and make it a scarce asset, which is great for its long-term value, but it's absolutely brutal for the people whose job it is to produce it. The hope for miners is always that the price of Bitcoin will double to compensate for the halving of the reward. If you're getting half as much Bitcoin, but each Bitcoin is worth twice as much, you break even. And while the price did rally to a new all-time high in October, it didn't double and stay there. The price surge wasn't enough to fully offset the revenue loss for many miners, especially with the cost of production already being so high. The halving essentially raised the break-even price for every miner on the network, pushing many of them from a state of profitability into a state of loss. This halving hangover is a primary driver behind the recent wave of selling. Before the halving, a miner might have been able to cover all their costs by selling just 30% of the Bitcoin they mined. They could happily store the other 70%. But after the halving, with their revenue cut in half, they might need to sell 60%, 70%, or even 100% of their newly mined coins just to stay in business. The halving forced an economic reckoning upon the entire industry, separating the highly efficient, low-cost operators from those who were just getting by. It was a survival of the fittest event, and we are now seeing the consequences. Faced with razor-thin profit margins in Bitcoin mining, many of these companies are doing what any smart business would do. They're diversifying, and they've found a new, incredibly lucrative field that just so happens to require the exact same infrastructure they already have. Artificial intelligence. The AI boom has created an insatiable demand for massive data centers capable of handling high-performance computing. And what are Bitcoin mining facilities if not massive data centers with access to cheap power and industrial-scale cooling? It's a match made in technological heaven. Miners are realizing that the same warehouses and power agreements they use to mine Bitcoin can be repurposed to train AI models. The financial incentive is staggering. According to industry estimates, using their infrastructure for AI workloads can generate 2 to 5 times more revenue per kilowatt hour than using it for Bitcoin mining. Let me repeat that. 5 times the money for the same amount of electricity. It's an economic no-brainer. This has led to a strategic pivot across the industry. Miners aren't just flirting with AI, they're getting married to it. In August 2025, Google itself made a massive investment in the miner Terawulf, specifically for AI infrastructure. Other miners like Bitfarms have announced plans to exit Bitcoin mining completely by 2027 to focus solely on AI. Now, it's not as simple as flipping a switch. The ASIC computers used for Bitcoin mining are highly specialized and cannot be used for AI, which requires different hardware like GPUs. So, miners are either building out new facilities or retrofitting existing ones with AI-capable servers. This pivot is being treated as a parallel business. Many are not abandoning Bitcoin entirely, but are instead using the profits from their new AI ventures to subsidize their less profitable mining operations. The AI business becomes the cash cow that funds their passion project, which is still mining and holding Bitcoin. This move into AI is both a threat and an opportunity. It's a threat because it diverts capital and focus away from the Bitcoin network, but it's also a huge opportunity for these companies to build much more resilient, diversified businesses. By adding a highly profitable revenue stream, they can better withstand the volatility of the crypto market and the economic shock of events like the halving. In a way, AI could become the savior of the Bitcoin mining industry, providing the financial stability needed to continue securing the network, even when mining itself isn't particularly profitable. So, how are these miners paying for all this fancy new AI hardware and expanding their mining fleets in such a tough environment? They're borrowing money, a lot of it. By October 2025, public mining companies had collectively taken on about $12.7 billion in debt. To put that in perspective, that's up from just $2.1 billion the year before. That is a massive, 6-fold increase in leverage in just 12 months. They are essentially funding their present survival and future ambitions by taking out enormous loans. This capital is being used for everything from buying next-generation mining rigs to building out brand-new AI data centers. This strategy is incredibly risky. Loading up on debt is like strapping a rocket to your back. If things go well, it can propel you to incredible new heights. But if anything goes wrong, the whole thing can explode spectacularly. These companies are betting that their investments in more efficient mining hardware and lucrative AI services will pay off down the road. They're hoping that future revenues will be more than enough to cover their debt payments. For now, much of this debt isn't due for several years, giving them some breathing room. But it's still hanging over their heads like the sword of Damocles. The structure of this debt is also worth noting. Many miners are using something called convertible notes, which is a type of loan that can be converted into company stock in the future. This is a clever way to manage risk, as it might mean they can pay off their debts with equity instead of cash. This could shift the future selling pressure from their Bitcoin holdings to their company stock. However, it also means diluting the ownership of existing shareholders. It's a trade-off, and it shows just how creative these companies are having to be to navigate this financial tightrope. The biggest risk here is a prolonged bear market. If the price of Bitcoin were to fall significantly and stay down, or if the projected revenues from AI don't materialize as quickly as hoped, these companies could find themselves in serious trouble. With massive debt payments looming, they would be under immense pressure to raise cash, and for a mining company, the quickest way to raise cash is to sell their primary asset, Bitcoin. This mountain of debt creates a potential scenario where miners could be forced to sell large amounts of Bitcoin into a weak market, not to cover operating costs, but simply to avoid bankruptcy. Okay, so miners are selling. They have to. But does this mean you should panic and sell your Bitcoin because the price is about to crash to zero? Probably not. It's important to put this selling into perspective. The largest miners have collectively sold around 8,000 Bitcoin in 2025. While that sounds like a lot, it represents less than $1 billion in selling pressure in a market with a total value of well over $1 trillion. It's a significant amount, but it's not a market-breaking cataclysm. Most of this selling is also done in a way that minimizes its impact on the price. Instead of dumping all their coins on a public exchange at once, which would cause the price to plummet, most miners sell through over-the-counter deals. This is like selling your house directly to a known buyer instead of listing it on the open market. These are private transactions between the miner and a large buyer, and they happen off the books of public exchanges. The market often only finds out about these sales after the fact, when the miners release their monthly operational updates. This process helps absorb the selling pressure without causing immediate, widespread panic and volatility. However, that doesn't mean miner selling has no effect at all. It can, and does, cause short-term price drops, or volatility events. While OTC deals are preferred, sometimes large amounts of Bitcoin are moved onto exchanges, and the market notices. For example, when MEA Holdings moved 644 Bitcoin to an exchange in November, it coincided with a 12% drop in Bitcoin's price that day. It's impossible to say for sure if that transfer caused the drop, but the correlation was enough to make traders nervous. These on-chain movements act as a signal, and even if a sale hasn't happened yet, the fear of a large sale can be enough to trigger a sell-off. Ultimately, the selling from miners should be seen as a persistent but manageable headwind for the Bitcoin price. It's a steady stream of supply entering the market that has to be absorbed by new buyers. It's not a tidal wave that will sink the ship, but it is a constant current that the market has to swim against. As long as the demand for Bitcoin from retail investors, institutions, and ETFs continues to grow, it can easily soak up the supply coming from miners. The real danger is not the routine selling to cover costs, but the potential for a large, forced sale triggered by debt, which could cause a much more significant, albeit likely temporary, market dislocation. So, with all this talk of miners selling, pivoting to AI, and even going out of business, should we be worried about the future of Bitcoin itself? What if they all just quit? The short answer is, don't worry. The Bitcoin network is brilliantly designed to be self-healing and resilient. It doesn't rely on any single company or group of miners to survive. In fact, it has a built-in mechanism to handle this exact scenario, and it's called the difficulty adjustment. This is the same feature that makes mining harder when more people join, but it also works in reverse. If a large number of miners were to suddenly turn off their machines, perhaps because it's no longer profitable, or they've decided to go all in on AI, the network's total computing power, or hash rate, would drop. The Bitcoin protocol would automatically detect this and, after about 2 weeks, it would make the puzzles easier to solve. This difficulty adjustment ensures that a new block of transactions is still found roughly every 10 minutes, no matter how many miners are active. It's like if the world's best marathon runners all retired at once, the race organizers would just make the next marathon shorter and offer a bigger prize until new runners showed up. We've already seen this happen in real life. In 2021, China, which at the time was the world's hub for Bitcoin mining, banned the entire industry overnight. The network's hash rate plummeted by over 50%. It was the biggest stress test in Bitcoin's history. And what happened? The network experienced its largest ever downward difficulty adjustment. Mining suddenly became incredibly profitable for everyone else, and miners in other parts of the world, like the US, rushed to plug in their machines. The network didn't skip a beat. It remained fully operational and secure the entire time. This is the beauty of Bitcoin's decentralized design. The system is built to survive. If old, inefficient miners are forced to quit because of high costs or debt, it simply creates an opportunity for new, more efficient miners to take their place. The network purges the weak and rewards the strong, so while the struggles of individual mining companies can cause short-term market volatility, they pose no existential threat to Bitcoin. The departure of one miner is simply an invitation for another to join. The network will keep humming along, processing transactions, and producing blocks, just as it was designed to do. The players may change, but the game goes on.